Hi traders, hello. Welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a quick look at the disclaimers, I'll just run through some of the key objectives of this webinar. We think basically markets are driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. What we hope to get through in the next 30 minutes or so is just to look at those key themes. We'll look at how markets are shaping up at the moment. We'll check out some of those main themes and have a couple of charts around those themes. And then we'll review all the main risk events that we have seen in the last few days, how they're impacting on markets and any themes generating from there. We'll look at all the associated FX currency pairs. And we'll also then look at any major data coming up, which is probably the PMIs out tomorrow, survey data, which especially in the Eurozone could impact euro dollar. So that's what we hope to get through in the next 30 or 40 minutes or so, hopefully 30 minutes. And here's just a rundown of, yes, what we are expecting in more detail to look at. Markets at the moment, interesting. Well, US equities ended that 6-day win streak that we saw. Asian markets, though, on the other hand, extended their gains, and Europe actually were flat to mildly positive when I last looked at 2-month highs. So a slight difference here between US markets and European and global markets. And it's really around extending that theme about potentially the sell America theme we have here, especially with the dollar and that going lower towards those recent cycle lows, which we'll look at shortly. And then also US stocks just pausing after this monumental rally that we've seen from the lows after Liberation Day. The VIX, interestingly, still pretty flat at 18.18, that is, which is the long-term average pretty much. And that's obviously come down from just above 60.60 in early April, of course, around the tariff turmoil. Interesting, Bitcoin actually near record highs now, all-time highs, and just slowly progressing. And it looks like, yeah, really quite, really will post new highs very soon. In fact, let's just pull up that chart. We don't look at Bitcoin very much. But yeah, it's good to, just because I noticed some really nice technical patterns on here, just upside breakouts in Bitcoin. If I just pull up the charts, just bear with me 1 second, you can just see these really nice consolidation periods, and then before a breakout to the upside, and then consolidation again, breakout to the upside, consolidation again, and we haven't had this bigger breakout to the upside. And you can just see it was just a little bit whippy around here, which is obviously just close to those record highs. Understandable, really, that markets traders get nervous around these big levels. Of course, that record high at 109.358, you can see there from that high, spike high, really in January of this year. So we're just edging towards that and just backing off slightly at the moment. As I say, really nice technical breakouts. The more we really like how data can consolidate and range trade for a while, and then you normally get range expansion after that range contraction, and normally in line with the recent dominant trend, and that's what we're seeing at the moment in Bitcoin potentially. Otherwise, fixed income, Japanese long-term government bonds are in the news as they continue those yields to rip higher. Really, the 30-year now at its higher since its introduction in the late 1990s, actually. And also then US Treasury yields, they continue to chop around or just below pivotal levels, actually. So the 10 years near 4.5%, the 30-year US Treasury just below 5%, that key level that we all looked at around those around tariff turmoil, of course, and the 2-year even similarly stuck near the 4% level. just below. So interesting levels, really interesting levels for Treasury yields as that Japanese JGB yield, especially in the long end, gets a lot of press. Currencies, otherwise, as I said, the dollar is weaker. Again, and we'll look at that shortly. Just checking that you can see what I can see, so just bear with me 1 second, and I'm sure you can. So yes, dollar lower, euro dollar above 113, highest in 2 weeks. Dollar yen down for 7th straight day. Sterling hitting fresh cycle highs after its CPI released. Those highs last seen in 2022, so 3-year highs in cable. And we'll look at some of those pairs in more detail shortly. Otherwise, commodities, really interesting. And we want to bring up gold first of all, because there might be an upside breakout in play here. We highlighted probably this double top and the neckline at around 3,200. We broke down below that, but found support around the 50-day, that blue line at 31.84. And now we're just pushing off that sort of level and moving higher. Obviously, there's Middle East risks with reports Israel is preparing to strike Iranian nuclear facilities. And then that has pushed oil up actually as well. So there's haven bid on gold because of that, and also, of course, because of around just this fiscal health question of the US economy. And as I say, crude as well is pushed up as well. I want to show you that chart. So we just looked at gold. Let's look at oil as well. This is Brent crude. You just see this double bottom in play, but really we need to break above that 50-day moving average. Interesting there, 66.80 that is for crude. And this comes amid, of course, markets trying to grapple with the prospect of an oversupplied market later this year as well. So just bear that in mind with crude. Otherwise, US stocks, let's just pull up a couple of charts. So firstly, the S&P 500 and this incredible rally. I just want to show you actually before we get to that, just a chart I have, a couple of charts around the stock market rebound. In here, you can see this 22-day gain. We're just beyond that now actually, but you can just see where it sits in history really. This is since 1990, and you can just see it's up there with some of the all-time historic days that we've seen in markets. So obviously the GFC features, COVID of course, then these blow-ups around LTCM. If you're in markets then, hedge funds blow up there, Enron as well, a blow up, and then Desert Storm, which is of course that Iraq conflict in 1991. So yeah, that's where we are with this historic rally, quite incredible. And if we just pull up then the S&P 500, you can just see on the chart, of course, yeah, big rebound, big V-shaped rebound really since 48.35, that low, and we're now just a couple of percent, 3% or so from that high, 61.47. We've got supports, we've got it here around 58.78, 58.66, so potentially just a pause before then we're moving higher. We are slightly overbought, or we were, so we're just pulling back from that, easing those overbought conditions. So that's the S&P 500. Nasdaq, similar chart. You can just see consolidation there. Really interesting consolidation over the last few days. That for us is bullish consolidation before then a push higher. Sorry, that's the New York FANG. So that's really interesting in itself. We have this chart, which is obviously basically the MAG 7 more or less, give or take a couple of names, and you can just see, yeah, just pausing before that record high around 14,000. If we look at the Nasdaq, similar pausing, bullish consolidation for us, should break to the upside in line with the dominant trend as long as we probably hold around 21,000. Then 22,222 is in sight for us if we do break higher. Then the Dow as well. Less of a big rally in the Dow, though we have seen it perform better with defensives doing better, utilities, healthcare doing better over the last few days. Just broken above the 200-day moving average, that black line, that's at 42,307. So if we can stay here and then push higher, then potentially, well, the all-time high is just above 45,000. You can see there. Okay, let's get now to, well, also, sorry, the dollar, I just want to talk about that. And we'll look at this chart shortly, but the DXY we'll look at. But just this is week to date at the moment. You can just see the dollar underperforming, getting sold on the back of that Moody's downgrade, really. Many people in the market kind of dismiss the ratings agencies, but this has really just highlighted the dire sort of state of the US fiscal outlook, and then also that Washington isn't really prepared to address those issues anytime soon, it would seem, especially with the new Trump beautiful bill, as he calls it. So, yeah, selling of the dollar, worries about the fiscal sustainability, debt projections really of the US, and that has seen flows again. We're seeing into the euro, even though we're seeing dovish chatter from the ECB, potentially 2 rate cuts still for this year. Yes, the issue is, well, liquidity, and where does liquidity go? It goes to the next major currency, and that being the euro, Swiss and yen doing well on the sort of haven bids as well as then sterling also outperforming the commodity dollars, just because of this risk sentiment, subdued mood, if you like, and sterling benefiting from that, even though we have a whiff of stagflation coming potentially. We'll look at that shortly. But let's now move on to, the most recent bits of data, and the US inflation data was probably the biggest. That surprised modestly to the downside. It rose 0.2% month on month for both headline and core in April. That was below the 0.3% readings expected. That meant the headline is now down to 2.3% year on year from 2.4. That's the lowest reading since February 2021. While core, that's of course excluding food and energy, that remains at 2.8%. So little evidence at the moment of tariff-driven price pressures, slow core goods inflation, and a slight decline in food prices. Energy and shelter inflation exceeded expectations, while core services inflation, that's excluding shelter and healthcare, that stayed negative, indicating really quite subdued price pressures despite the trade war. Shelter components, we always talk about this. This makes up over 35% of the inflation basket, so an important number to look at. By weight, of course, that continued to run at elevated rates, 0.3% and 4 month on month, 4% year on year. But the good news is, at least, that most economists see that lead indicators, that's like new tenant rent series, they are falling in year on year terms. And that suggests, based on really the historical relationship, that housing costs will slow sharply later this year, or at least early next. And that could then counter, obviously, any tariff price rises. Important, of course, to remember as well, the US inflation basket dominated by services, commodities, ex-food and energy, which is what is going to be impacted most by tariffs. They make up only sort of 19% of the basket of products and services used to calculate inflation. So then housing and services can help to mitigate, as I've said, the inflation threat from tariffs that is going forward. Also, we had last week, well, just to show you here's the tariff concerns, of course, raising inflation expectations on different time frames. And then we've had, obviously, just this chart. I need to update this, but the core dropping to 2.3, headline dropping to 2.3. Lowest since 21, of course, and then core staying at 2.8. We did have April retail sales as well out of the US, broadly in line with expectations, but interesting, the control group, very, very soft. That is the measure that tracks or records the underlying trend within consumer spending, probably the best. And remember also that retail sales only account for around 42% of total consumer spending. So yeah, retail sales, the control group, very soft, negative 0.2 month on month versus the expectations of plus 0.3. Remember, it's also a nominal figure, so we need to deflate it to give us the real growth as measured in GDP, and that would actually imply a negative 0.3 or negative 0.4 month on month contraction. That would be really poor, of course, given the market had expected a continuation of basically preemptive buying to get ahead of tariff-induced price hikes. So just bear this in mind, really important data potentially going forward. And we also had mixed PPI data actually as well. That feeds into the Fed's favored inflation gauge, the core PCE deflator. So that points to potentially a 0.1 print next week when we get that Fed's favored inflation measure. If we just look at the dollar chart then. Just remembering, of course, there's a heavy weighting in this of the euro. 6 of its trading partners, US main trading partners, but the euro has by far the biggest weighting in this index, about 56% or so. And you can just see, yeah, rolling over now. We got up to the 50-day moving average. That's now 101.52, the blue line. We've got a couple of levels in here going back some time, swing lows in December 23 corresponds with those September lows, and then we've got this low around the July 23 level as well. Big levels for us, 99.57 and then 161. That latter level, 161, obviously resistance there, and we're just rolling over now into the 99.57 level. But of course, that cycle low from April is at 97.92. Looks like decent momentum now going through if we can get past that 99.57 level for us. Okay, also we had the RBA meeting, just touch upon that, and we've just got a chart as well that just shows the core inflation levels and also wage growth. But the RBA, well, the cut rates as expected by 25 basis points to 3.85%. They said demand and supply closer towards balance. Inflation continues to ease, and you can just see that in the left-hand side chart, of course. Trimmed mean Q1 annual inflation below 3% for the first time since 2021. And headline inflation 2.4%, so that remains within the 2 to 3% RBA target bands. We are up the upper end of it on the probably more important trimmed mean number, as I've said, 2.9, but still below and into the band as we mentioned. New forecasts indicate headline inflation might drift back higher due to temporary factors, but underlying inflation would stay around the midpoint of the 2 to 3% target. That's crucial for the RBA. Of course, international uncertainty remains high, they said, and that might have adverse effects on the economy while businesses continue to report weakness in demand. For the GDP forecast, they expect those to pick up slightly, actually, but at a more gradual pace than initially expected. So 2.1% this year, 2.2 next year. And really, it was all in all actually quite a dovish assessment, really. Markets had expected a more hawkish assessment. Bond yields, they dropped by about 10 basis points, actually, the 3-year yield to just above 3.5%. And money markets now see 2 more cuts this year, with the next 25 basis point cut fully discounted actually in August. Remember, the RBA only has 8 meetings a year, and the dollar, Aussie dollar, sorry, that eased marginally, but still remains within its range. If we just look at that chart then. You can see it here, we're in this range. 63.15, 65.15 more or less. That black line is a 200-day moving average. That's a 64.53. You can see, so that has capped the upside so far. The longer we track sideways, the bigger the breakout will be. We always say that. So potentially, if we can push above, obviously the 200-day decisively, say on the week, or then the 65.14 level from early May, then we have the 65.49 level to aim for. But that could potentially happen quite quickly if we do break to the upside. Otherwise, downside, well, 63.15 or so, probably the bottom of this range. And then you've got, well, actually the 50-day moving average just above that at 63.38. Otherwise, next fib level, major fib level, is from this high down to the low. The 38.2 is at 63.06. Okay, also we'll just touch upon UK inflation, and we'll bring up the cable chart now. and you can just see that spike higher up to 134.68, so breaking 134.34. That was on the inflation data. Yes, it was. So that came in hot, expectedly hot, really. It's an April number, and in April we always get these raises in service sector prices, electricity, that kind of thing. So they always impact April, and then they're normally to the hot side, even above expectations. So we had services CPI, that spiked. That's a key number for the Bank of England. That spiked from 4.7 to 5.4% against most expectations for around 4.8%. All that said, though, most of the jump, economists reckon, can be traced in that number to a spike in road tax, actually had an outside effect, along with higher airfares and actually package holiday prices. And they were all skewed, if you like, by the timing of Easter and the specific measurement day in April. So a lot of economists think this will be reined in the next few reports, because other key components like rents, catering, they all saw year-on-year rates continue to ease, actually. So probably the MPC will look through this point and wait for the next readings. And then going forward, inflation will or is expected to lower back down towards target through the summer. Bank of England's rate cut expectations were pulled in, of course. June really no longer an issue. They do go quarterly, as we know, the Bank of England, so an August cut probably more likely. But of course, underlying services inflation, that trend will need to continue to improve or start improving when discounting, of course, these tax-related distortions as well. Cable, you can just see, yeah, just pull back below that 134 level. You can see it was a previous high in April, and then also prices hit that and pull back in September of last year as well. So pretty decent level of resistance. Otherwise, we probably need to go back to probably these levels here around 136 and above there as the next key level if we can break above that. And you can just see consolidation after the last few weeks, and then this push higher potentially, which may come soon. Okay, let's now just move on to our final section, which is PMI data. And normally markets focus on the Eurozone and also probably UK data as well. So we'll look at the Eurozone data and then check out Euro dollar as well. For the Eurozone then, well, there's been no real sign actually of the economy experiencing a negative shock from the trade war. April's PMI showed surprising strength in manufacturing, which followed an exceptional first quarter for the sector, all probably due to front-running US tariffs, of course. May will show well how resilient the sectors is to the global turmoil, and if we get really a Q2 correction after that temporary boost. So manufacturing, that's expected to hit 49.5 in the region. Services, a slight uptick to 50.3, and then composite as well, an uptick to 50.8 from 50.4. Other survey indicators such as the Centix and ZEW, they have rebounded, so that suggests potentially that initial wave of pessimism following the Liberation Day tariffs may have moderated, so it'll be interesting to see what happens. And also, of course, we've had the temporary 90-day tariff truce between the US and China, and that should potentially ease market anxiety around global trade. Of course, US-EU trade relations, we shouldn't forget, they are still a little bit tetchy, we should say. There has been, or as meant to have been, some progress over the weekend, but still nothing really of note has been leaked or said by President Trump, really. And also, actually, US Treasury Secretary Bessent, he said actually progress was slow. From a policy perspective, ECB widely expected to cut rates in June. Weak PMI really would just reinforce that view. So let's look at euro dollar. which, as I said, has moved above 113, 2-week high pretty much. Looks like, yes, we're trying to get now towards 150, 114, sorry, and then the highs obviously 115.72. We've got the minor fib level 23.6 at 112.43 as maybe some support. Otherwise, that 50-day did cap the downside in when last Monday, and that's now risen to 111.31. So just watch that for support in euro dollar. Otherwise, UK PMI data, well, we also get that on Thursday. Manufacturing scene slightly higher, but still well below 50, 45.9. Services also below 50 at 49.5, but ticking up from 49 previously. And then, we did see that sharp deterioration in April with the composite below 50 at 48.2. That was the first contraction actually since October 2023. And manufacturing as well, that dipped to its lowest level in nearly 3 years. S&P Global, who report the figures, they cited falling demand, domestic and external demand, with new orders declining for a 5th straight month, export business contracting at the fastest rate since May 2020 actually. Of course, we've had that tariff truce now between US and China, so that might give us some relief on trade sentiment. But of course, domestic cost pressures really and demand fragility are probably going to persist in the UK. A sub 50 composite print in May, that would reinforce the narrative of a stalling UK recovery really, and potentially support expectations for a summer or late summer BOE rate cut. There was around 44 basis points of cuts priced in, although some of those have been priced out now since that stronger CPI data, but probably an August cut still seen as likely if the Bank of England MPCs look through that CPI data. We do get, I think, another CPI report before the June meeting as well. Yeah, we've looked at cable. If we just look at euro sterling, don't look at this often, but interesting because we've spiked up above 87 in sort of mid-April, fallen back sharply really to the 100-day moving average, that grey line, and just above the 200-day moving average, that's around 84, and we're just pushing off that now into the 50-day at 84.65. So yeah, that's euro sterling, and we're just pulling back now the bearish momentum back to sort of neutral levels around 50. Okay, we will wrap it up there. Thank you so much for being on the call. Really do appreciate you spending the time to listen to us. We will be back in a couple of weeks. So take care out there and we'll speak to you soon.